In the past year, Celsius is down over 50%. And from its all-time highs, this company's share price has actually decreased by over 70%. However, if you were a long-term investor, meaning that you probably bought the company about 5 years ago, there's no worries, you would still be up. However, this company is currently trading at the same price that it was trading at around June in 2021. Why has that happened? And is this 70% price decrease reasonable? Well, today we'll actually be looking at the financials of the company. We'll be seeing whether this price drop actually makes sense, and we'll also be looking at some different investment theses which argue both sides. On the one hand, that this may be a very good opportunity to buy a very good stock at a very good discount, and on the other hand, that this is actually a value trap, and even if you buy at these prices, you should be prepared for the stock to drop further. So without any further ado, let's just start with this analysis. Now, for those of you that don't know what Celsius does, it actually markets, distributes, and produces these energy drinks that are competing with Red Bull, Monster, and have a very unique value proposition. In theory, these are geared towards athletes, and there are studies that prove that by drinking them, you can enhance your overall sports performance. This is one of the main reasons why this company has gained tremendous popularity over the past years, and why we can see over here that their 3-year revenue CAGR is over 75%. So this company has been a monster growth stock, which is why over the past 5 years, it has returned over 1,000%. Now, having said that, this company was doing extremely well and shareholders were living life at its fullest up until March 2024, when this company actually started to have some issues and the price started to collapse. I have been looking at the company's numbers, and of course we do have to take into account that this is not a mature business yet. It is still considered a growth stock, they're growing their revenues pretty quickly, and they shouldn't be expected to have very stable margins, very stable efficiency ratios just yet. Having said that, we can see that the return on capital employed is 4%, and that their margins are actually looking pretty solid for a company that is growing at this speed, with their net margin being over 15%, which is the usual threshold that we have for these kind of stocks. Having said that, this company is still only at a $6 billion market cap, and the total addressable market for these type of products is a lot larger, so they could still have a lot of room to run. Having said that, their price to earnings is still over 40 times, a very hefty premium to pay even if the company is growing at a pretty fast pace, because we have to remember that this company is still down 70% from its all-time highs. Over here we can see Celsius' explosive growth year by year. We can see that 2023 was actually like its standout and turnover year, because it went from a net income of negative $200 million to a net income of positive $226 million, all while doubling their revenue from $600 million to $1.3 billion in revenue. However, some of you may have already noticed, when you look at the last column on the right, this is their last 12 months, so their last 4 quarters, this doesn't look as good. Their net income has decreased, their margins have decreased a little bit, and they haven't grown that much. So when we break their numbers into quarters, we can see where the problem originated. Well, first of all, the one that calls out a lot more attention is the latest quarter in September 2024, where revenues went from being in the $50 to $70 million range all the way down to $6 million for the full quarter, bringing their net margin down from a 20% to a 2%. Now, as you all may know, the main reason for this has to do with their inventories. And don't worry about this, we will discuss further. But this is something that you should have in mind. Regardless of what the reason is and if it's reasonable or justified, this company's latest earnings were very bad. But I want to take the view out from this latest quarter and I want to zoom out and view at the trend. This company had been growing exponentially from December 2021 all the way up to September 2023. But from September 2023 all the way up to June 2024, so let's not include the latest quarter, their revenues have actually become quite stagnant. Of course, this is not unreasonable. It happens to every company. One thing management has to focus now on is to grow this revenue again. Now, as we like to do, I've added the free cash flow in pink, so it's easy to visualize. You can see that this company, whenever they want to, is extremely good at generating free cash flows, usually being quite similar to their net income and being extremely efficient. And when we look at this company's balance sheet, there is nothing to say. It looks perfect. They have over 3 times the total assets than their total liabilities, and this has been maintained over all the previous quarters. And when we look at the free cash flow yield, this also looks very similar. They're currently trading at a 2.7% free cash flow yield, which is very close to the 3% long-term inflation. And from what we know, this actually implies that they're trading at around fair value, just a bit on the overvalued side. But enough said about the financials. Let's take a look at the different investment theses and see what they have to say. Now, as I stated previously, the main reason of why their latest quarter has been so bad was because of the inventory of their major distributor. Now, this major distributor, as you may know, is PepsiCo, which also happens to be one of the major shareholders of the company. They basically help out Celsius distribute and place all their product to different shops, to different retailers, and just allow it to reach the final client. Now, as we saw through the past 4 or 5 years, this company has grown at exponential rates, and it was very hard for PepsiCo to actually know how much of the product it had to stock and how much it had to order. So what it did is it just ordered massive amounts of Celsius products and placed it all at the different retailers. This in order to not lose out on revenue, and as long as the demand kept extremely strong, this was a strategy that actually worked a lot in favor of both companies, both PepsiCo and Celsius. Celsius revenues have been extremely stagnant for the past 4 quarters prior to the latest one. However, PepsiCo still kept ordering these massive amounts of products, and in this latest quarter they actually realized, hey, your growth and demand have slowed down a lot, so now we can actually predict how much you will sell quarter after quarter. We have a lot of your product stocked because we thought that you were going to sell a lot more. So what we're going to do now is we're going to reduce our inventory. We're going to give retailers all that we have in stock and not order so much from you this quarter. This, of course, means that their major distributor has ordered so much less Celsius product in the past quarter because they were using all the left order stock that they had from previous orders. Now, the CEO stated that if we normalize this and we just looked at their sales without considering inventory issues and all that, it would have otherwise been a very solid quarter. Because this doesn't actually affect customer sales. Customers can still find Celsius at their latest department store, their latest retailer, and buy it as if it were a normal product. One extremely important thing to note is that this is not expected to continue. As you can see that the CEO actually said that the supply chain adjustment has stabilized, meaning that it is expected for PepsiCo to keep placing very large orders to buy from Celsius. But we don't know if they will be at an all-time high or if they will be just as stagnant as they used to be in the previous 4 quarters. I like to be transparent in my opinion, and sometimes I can be wrong, but at least I can make you think about the different investments. For example, over here, it says that their net income actually dropped a staggering 92% year over year. And of course, I understand that a huge component of this can be caused by their distributor not buying as much product. However, a 92% drop in net income when the revenues were down only 31%, I believe that could be hiding some different components. But there is no way to find out until we see the following earnings report. In this article, they say that through PepsiCo, Celsius can still track their growth, even though it's not been products that have been sold to PepsiCo, but products that PepsiCo is selling. And they saw that the sales actually grew at 7% year over year, at least in multi-outlet retail locations. This used to be a company that was growing its revenues at a 70% 3-year CAGR. Now it's growing at a 7% year over year. These sales to me don't classify this company anymore as a growth stock. On the other hand, I do love that this is a super profitable company, that it has very solid free cash flows, and that it's able to, even if they don't grow their revenue at such a quick pace, their net income and free cash flow generation ability is so large that they could return a lot of value back to shareholders, even if it was just through dividends or through share buybacks at points when the company was actually undervalued. For example, if management thought that this was only a slump in the shares, hopefully they have been buying back these shares in order to return this value and all the free cash flow that they generate back to investors and therefore maximize the stock returns. There is one other consideration that we can see here. The author says, the energy drink category is tepid right now, and other smaller brands are also taking market share. This raises questions on how much of a moat Celsius has for the long term. I believe their value proposition is very unique and that they have managed to grow this and develop a very loyal following and customer base. Personally, I'm not a big fan of energy drinks, but I do agree that if there are a lot of different small brands that are taking market share away from Celsius, from Red Bull, and from Monster, this could just mean that the industry is breaking apart and becoming a lot more fragmented, which actually raises this question. Does Celsius actually have a competitive advantage over all the different categories? Was this just a trend? Will people forget about Celsius 5-10 years from now? I personally believe that they won't, but these are questions to ask yourself. Now, before we move on to valuation, I'd just like to leave you with this because I believe it's their greatest issue. Their decelerating growth. Even if they hadn't had a horrible quarter because of their distributor reducing the inventory they had and therefore ordering less from Celsius, their growth has actually decelerated so much that it is now not a growth stock. They don't deserve to be trading at these very high multiples of growth stocks such as Nvidia, such as Palantir, or other companies that are growing at very high double-digit figures. Because as we saw in the latest article, Celsius estimated that their year-over-year growth had been 7%. I believe that this impact will still be noticeable in the following earnings report, but that at least management will be able to give some more clearer guidance onto where this company is headed for the short to mid-term. And I do actually hope that this is just a bump in the road, because I would love to see a company like Celsius manage to take on these huge rivals that have been around for a very long time, such as Red Bull and Monster. This is what the author thought of their valuation. I agree with this author in that the shares are still expensive. They trade at a 42 times earnings when the revenues have grown at a 7% year over year, as stated by the CEO. Of course, this is a lot lower if we compare over their averages, but their revenue is even lower than if compared to their averages. Now, I'm not a growth investor. I like companies that are a lot more predictable than Celsius, but even if I was looking for a growth company, I would wait until their earnings to see some more predictability and less uncertainty on the direction where this company is headed. Having said that, however, if you stayed up until the end of the video, thank you so much. I hope this was of value to you. If you have any other stocks you want me to review, leave them down in the comments, and I'll see you in the next one.